So thank you everyone for attending today's session. We have Greg Ansel on the call, part of Armanino, who is they're a member of the CREC Directory. Greg has a very vast history in valuations across all types of industries, but he's worked on a lot of cannabis accounts, and we look forward to his insights. Before we get started with Greg's expertise, I'd like to introduce you all to the CRF Directory. It is the listings of trusted professionals that we work with. We've opened up our network to allow other people to reach out to the people that we know are trusted within this industry, whether it's capital or legal service or tax and HR prep that Armanino offers. If you'd like to reach out with them during this call, after the call, you're welcome to visit the listing on our website. So you go to Network CRF Directory at Armanino. We'd be happy to make an introduction on your behalf, and you can learn a little bit more about the company as well. And cannabis valuations is a hot topic, and I think one of the reasons why we all have gotten into this industry in the first place is to cash out at the end. And while it seems like a long journey, there's a lot you can be doing to prepare along the way to set yourself up for success, and also to manage your expectations. And with a growth industry like this, there's a lot of different ways to value and time periods and methods of valuation. And so Greg is going to explain more about his experiences and what you should be looking for while you're growing your business and how you can be set up best for success. As I said, please ask any questions in the Zoom chat and we'll be happy to answer them. We will be sending out a recording at the end if you are on the CREC newsletter list. So please make sure that you join our newsletter. If you are not already, you can go to the news page of our website and join here on the right. Click here on news. We also post regulations updates, other educational content. And if you haven't checked out the CREC blog, it's part of our goal to expand the knowledge of our audience and help everyone to succeed more in a complicated industry. So please feel free to reach out and see how you can assist our community and what we have to offer as well. So at this time, I'd like to hand it over to Greg and get him started.
Thank you, Roger, and I appreciate the opportunity to speak here today. Appreciate everybody in attendance, and we will get into the valuation of the cannabis business and maybe some unique things to look for when doing the valuation, or things that maybe you can control to help maximize value for your business down the road. So with that, I'll move on to the next slide. Roger, you're going to move on to that? There we go. So certainly we'll talk about the introduction we talked about. We got the CREC overview, and then we'll go into my presentation here. And at the end, we'll leave plenty of time for Q&A so I can answer any specific questions you may have that either I will expand upon or things that maybe you want to ask that were not covered today. So move to the next slide, please. So certainly, I lead the group evaluation here at Armanino. And within that group, we have 3 senior people, all with 20 to 30 years of experience. We specialize in a variety of different valuations for different purposes. And then over the last couple of years, as you can imagine, our industry focus has moved towards valuation of cannabis as well. So that's something that we've done a lot of, as Roger said, but a lot of that's really happened over the last two plus years. So myself, I lead it, and then I have Dirk Van Dyke and Joe Rapier are my 2 people that work closely with me on valuation of cannabis companies. So we can move to the next slide. Just going to give a very quick overview of Armanino and our approach. I don't know how many of you are familiar with our company, so I'll just, again, be quick. Armanino is an accounting, tax, and consulting firm, about 1,500 people. We have about 15, 16 offices in the U.S. We're primarily in California, but we've expanded to Seattle, Denver, Texas over the last few years. We have an office in Chicago as well. And we have offices both in Northern California, where we have 4 offices, and I think we have 5 or 6 offices down in Southern California. We're one of the largest accounting firms. I think we're 22nd in the last list that I saw of accounting firms. And we do a lot of different things and a lot of different services. I kind of view us as a bit of a mini Big Four, even though we may not have as many people in all areas in terms of the services, and the diversity of services we offer is quite extensive. One of the things I think that separates Armanino, especially in the cannabis industry, is we've taken this as an industry approach. Obviously, a lot of people nibble around the edges of cannabis, but what we decided about 2 years ago was to treat it like an industry, such as we do with technology, real estate, not-for-profits, and really look at it as how can we serve the industry, not what services that we can provide, such as valuation in discrete ways, but really what are the challenges that the industry faces and how can we help? So obviously valuation is one of them. We can certainly help with the cap table, but really we're strong in tax and the issues that are unique to the cannabis industries. Obviously we audit them. We can provide back office accounting, and we do HR support for you. We have the tools with our consulting to implement budgeting and forecasting type systems for you. We certainly do strategy and transformation, help you with controls and compliance. And then obviously in this new world of COVID-19, certainly cash management, process reviews, and all those sorts of things, as well as we've put in interim controllers, CFO, or senior finance people. So when we look at cannabis, we don't look at it as how can I do a valuation for cannabis. What we try to do as a firm is say, what are the unique issues of the cannabis industry? And then how can we help the industry? So we can move on to the next slide. So now we'll get into, hopefully what you're all here listening for is some of the valuation issues. You know, what are some of the valuation methods we see in the industry? Maybe what's unique to the industry. Obviously, everybody talks about cash is king. And then we'll talk a little bit about purchase price, or what you can do to prepare the companies and hopefully maximize the value in an exit down the road. We can go to the next slide, please. So certainly when we talk about valuation, this is really basic valuation 101. When you go to any class, I've taught classes in valuation. We always talk about the income approach, the market approach, and the cost approach. So the income approach usually is a discounted cash flow approach. So it's a value based on forward-looking projections. There are other variations, but I would say that's the primary method. And I'll talk about them in a little bit more detail after this slide. The market approach is what many people are very familiar with. Multiples of earnings, multiples of revenue, maybe M&A multiples of EBITDA, EBIT. So again, it could be publicly traded companies, could be transactions, but usually looking at a discrete metric, either historical or forward-looking, and applying a multiple to it. The cost approach is the third method, and that really is just how much would it cost to recreate this business? Rarely used in this industry because it doesn't consider all the unique elements of the industry, maybe goodwill that is created. We'll talk about permitting later, but obviously there's cost to permitting, but the value is probably much greater than the cost. So again, rarely used for operating businesses, and especially for businesses in what I'll say evolving or newer industries. So can we go to the next slide, please? So the income approach, again, as I mentioned, the most common application of the income approach is the discounted cash flow approach. I'd say we see this method most frequently in the cannabis industry. What this method does, as we talked a little bit earlier, was it helped create cash flows or projections for the business. And over that projections, you then discount those to the present value. You add a terminal value, which is the value at the end of the cash flows, to estimate the value of the business. The reason this method is most commonly used in the cannabis industry and other evolving or growing earlier stage industries is it allows you to model the growth of the business, because usually the future is going to be very different than the past, and maybe different in the near term, such as you have heavy investments in the early time of the business. So the cash flows might be negative in the early years, but what you're really doing is investing in that business to create both high revenue growth, margin improvement, and stabilization over time. And that's what the income approach can really do. I'll talk about the market approach later, but if you're doing a multiple of revenue, but if your revenue is growing very fast or multiple of EBITDA, and you won't have positive EBITDA for 3 or 4 years, the income approach allows you to model that and take that into consideration. And obviously, when we discount it to the present value, we take into consideration the risk of achieving both the forecast, the risk of the industry, maybe risk of financing, a whole bunch of factors. Because, you know, an income approach, the common critique is you can make the value anything you want because you'll have these hockey stick projections, which are, you know, usually the big hyper growth, and then it hopefully tapers out at the outer years. So there's a great Dilbert cartoon years ago where the guy goes through and spends all this time on the projections and does this and that. And he says, oh, I'll just value it. I'll just change the discount rate. And it really kind of shows that all those things have to work into consideration. So the discount rate that you might use might be different for two very similar companies, because one might have very aggressive financial projections, one might have very conservative financial projections, and those have to be assessed as part of the analysis. So the reason that we find the discounted cash flow approach to be the most commonly used, it enables you to properly model, or to the best of your ability model, the company, the growth, the expected earnings over time, and then risk adjust it. And we find that very important in a lot of valuations today, especially with COVID-19, because if you did a projection of a company in January 1st, 2020, especially in an industry that is very hard hit by COVID-19, the projections and the expectations they would have thought then would be very different than what they may feel today. So the discounted cash flow allows you to model that over time. And again, it's particularly useful when the future performance is expected to be very different than the past, or maybe even the intermediate performance. Now, sometimes people will say, well, I don't really know what the projections will be. You know, I have various scenarios, you know, high, low, medium, low, base, best case, people call them different things. So you can do it different ways. You can do one scenario where you're maybe averaging or weighted averaging the three, or you can do valuations using multiple different scenarios and just come up with ranges of value. Because one thing is important about valuation, it is very subjective. So we're kind of coming to an objective conclusion based on a lot of subjectivity. And so when thinking about a value of a company, I always think that there's like a range of values that are reasonable. So if you use reasonable methodologies, reasonable assumptions, you'll come up with a reasonable answer. Now, if you're a buyer, you may push on those assumptions to be at the higher or the lower end of reasonableness, because obviously as a buyer, you want to buy low. If you're a seller, just the opposite. You might push on some of those assumptions to be a little bit more aggressive, but still reasonable, and you'll be at the higher end of the range. So this model allows you to do that, but usually I view it like a recipe. You know, the big parts are the projections. Usually the companies prepare them. We work with the companies in assessing them, talking through them. But then you have the discount rate, which is the risk factor to the present value. And then depending upon how you do your terminal value, which is the value beyond the forecast period, those are some judgments that the valuation professional has. So you try to balance all three of those together to come up with a reasonable approach. So usually the criticism of this approach is that there's way too many assumptions. It's way too subjective, and you can manipulate the answer to anything you want. I would counter to say, obviously, you know, having a valuation professional that's done this many times gets a feel for some of these factors, but also, as we go to the next slide, please, we look at the market approach. So even if we don't necessarily rely on the market approach, multiples, like I said, is revenue or transaction data, we'll often use this as a reality check, because the market certainly tells us what the value is. Again, just looking at the COVID situation, I use this example a lot, and this is general information. If you looked at the Dow or the NASDAQ as of 12/31/19, if you looked at it as March 31, 2020, you would see about a 20%, 20-25% decline over that time period. And so the market is a factor in value. So it's not just the DCF or the discounted cash flow approach in isolation, but you need to take market considerations into the analysis as a factor. And the market multiples are dynamic and they're not static. So, you know, if things change over time in the market and market expectations and valuations of industries, they're going to change. The market will have expectations. Again, in COVID-19, for example, if these changes are temporary or if they're more permanent. So you might see bigger declines in travel, leisure, hotel, airline industries that obviously are getting impacted significantly. But I believe the expectation that upon recovery, those might be slower to recover. Companies such as alcohol, food, and cannabis are probably, well, I know for sure, are doing better over this period because with more leisure time or staying at home, entertainment, gaming stocks, another one, they're seeing the results actually not impacted as much, in some cases even positively impacted due to the coronavirus. But so that's one thing. So the projections and everything you might see might be improved, but overall market values are still down, and that needs to be considered in the analysis. The data for the publicly traded companies or getting the transactions tends to be more variable. And what I mean by that, maybe a less perfect, especially in this industry, especially because we have to use more international data for the publicly traded companies. So we don't have as much maybe faith in some of the financial statements for the SEC filings that we would see in other industries. They tend to have much more volatility. So again, I think on the cannabis side specifically, we're seeing maybe good results, but we are seeing much more volatility in stock prices. And that obviously plays a role in the valuation. It plays a role in how the market perceives it. But the question then becomes, you know, is that a temporary increase or decrease, or is that more permanent? And those are some of the factors we struggle with today as we value these types of companies. You know, in a lot of these companies, depending upon, you know, where they are in their life cycle, we'd have to rely more on revenue multiples versus earnings multiples due to the growth that's, that they are putting into the companies and sacrificing short-term or maybe even intermediate-term profitability to invest in the company, invest in growth. So that market approach we do see used. We see it used less than the income approach, but it is used in the valuations. Cost approach, as I said earlier, rarely used. It just doesn't take into consideration the factors such as growth, investment, and is cost really the, is that really an indicator of value? So for certain types of companies, not in cannabis, but a real estate or a REIT type company, yes, that may work out well. Or a version of the cost approach, which we call net asset value. So you might adjust some of the like in a REIT, the value based on the real estate. So you'll do a net asset value, but that would be a much better situation where you use a version of the cost approach than you would in an ongoing business. We go to the next slide, please. All right, so some of the unique issues. I think I've touched on some of these already, but certainly I'll go into them in a little more detail. Newer industries, as cannabis is, at least for us on the valuation side. As I said, our firm, we probably nibbled on the edges 3 years ago or so, where we weren't really sure, but we were interested in it. We saw the potential in the industry, but I'd say really at the beginning of 2019, maybe a little earlier, we really went into it full bore where we said, you know, this is an industry we're interested in. So when you have a newer industry, certainly on the valuation side, a lot of times when people do valuations, especially in traditional industries, the thoughts are, especially in the market approach, if you're doing a multiple of revenue, multiple of earnings, that the history will be a really good indication of the future. And when you have newer industries such as cannabis, such as biotech, you know, the past is really a challenge because, again, it's in startup mode, it's in investment mode, it's looking for future growth. And there aren't a lot of mature companies out there that we have data on that we can say, this is what we expect this company to look like. So as we get in another year, 2, 3 years, we'll start seeing more and more of that information, and we'll have better idea on the data of history or comparisons of one company versus another company for both use of the market approach, but also use for benchmarking and doing the valuations. So do we know if 10% annual growth is a good growth rate, or is it 20% the first few years? Do we know if an EBITDA, which is earnings before interest, tax, depreciation, amortization, do we know if 10% is a good margin? Or do we know if 15% or 20% is a good margin? So in newer industries, it's much harder to benchmark that data. So we're making expectations. We'll either look at the few companies that may have positive information, or we'll look at similar related industries, or we'll try to make comparisons. So I know similarly in a real estate deal, when people are valuing real estate, one of the approaches is you look at this house versus that house, this building versus that building, look at what the rental rates are, or you look at square footage, or whatever the metric is that you're trying to compare for, and you try to adjust and normalize and say, if my company or my real estate was similar to that, that's how it would be valued. So we do a lot of that in business valuations as well. But the challenge is obviously in this industry is the information is much newer, and there isn't as much information out there. Similarly, in earlier stage companies, and obviously in your industry, not all accounting firms, consulting firms will work in the industry. So we rely on both historical financials, and we will rely on projections, which obviously are not audited, but the reliability of the historical and the forecasted really will impact valuations and expectations and the view of the company and its potential value. So if you have a reputable firm auditing or reviewing your financials, it will give investors more confidence on at least the historical numbers and maybe even on the management's ability to invest in some of the infrastructure and controls to show what the company might be worth down the road based on having invested in the financials, showing what potential values are. Certainly, as we mentioned earlier, finding good comparable companies is a challenge, especially in this industry. Seems like, again, it's fairly fragmented, which was my next point. But the industry is fairly fragmented, so different companies focus on different elements of the industry. Excuse me. So unique issues are finding good comparable companies, and part of that is the fragmentation is different people are focusing on different areas. Some people are focused on cultivation through the product, others on distribution, and obviously someone more on the retail side, and some looking at all elements of it. So those are areas that tend to add challenges. And again, just finding information, figuring out what's realistic about the projections, what is good expectations on growth, what's good expectations on earnings. And then depending upon the time, obviously the companies need capital. They need capital to grow. Capital 6 months ago was probably much easier to get than it was today. And so that impacts valuation, because the growth or the expectations or the ability to execute on the plan may be dependent upon capital. And that capital may be more challenging to get in certain times, certainly is now, as we've seen maybe 6 or 8 months ago. I think over time too, with newer industries, it's sometimes harder to find capital as well. But over time, as the industry gets to be more known, some of these other factors that we've mentioned earlier, in terms of being able to benchmark, being able to look at financials more reliably, will impact that as well and make getting capital easier to get, excuse me. So the other issues that we'll touch on, certainly understanding the tax issues. Not my area of expertise, but fortunately we have a whole team here at Armanino that can deal with this, but understanding the state and local taxes are very important. If there are any international tax rules, that's very important. Many of the companies that we have been valued are often US companies. Sometimes they have foreign holding companies. Sometimes part of their your sales are going abroad. So understanding all those things are really important to the valuation, really important to the firm, and to the firm, to the extent you can understand it, plan for it, and do the work, it will generally positively impact the valuation because it just removes another unknown situation. Management team is key, and this is true really for any company, but I would say in newer evolving industries, very important. If you have a team, even if they haven't done it necessarily in this industry, but they have taken a business, they've grown a business, sold a business, especially in a unique evolving industry, that's going to give the company a lot more credibility. And certainly on the early investments, many times that's based on the strength of the management team, their experience, their contacts, and their ability to have built a company before. And so really their success. So that tends to be very important. So we see that. We've seen companies, two companies, relatively similar. I wouldn't say exact, but you have one that has a management, what I'll call a professional management team, and one that's, really more, this is kind of, they've been doing this for years, but now obviously the cannabis industry has now gotten approval in a number of states. So now they're turning kind of what they've been doing for many years into really more of a business, but they're not really professional management teams. And those two companies would get different valuations. And obviously understanding regulation is key. I mean, state to state is different, country to country is different. Looking at land permits, are they temporary, are they permanent? All these things, it all comes down to understanding that, but really it's a proxy or measurement for risk. And anything you can do to reduce risk, generally, all things equal, is going to increase value. So understanding the regulation, seeing how much of that you can kind of put behind you would be important. All right, I think there we go. Valuation, cash flow is really the king. And when we talk about valuations, at the end, whether you're doing a multiple of revenue in the market approach, it's really revenue for some future level of cash flow. So the higher the cash flow, obviously, the higher the value. So what you want to do and what the expectations of investors are is looking at future cash flows, or what can you do to maximize cash flows. Certainly, the more you can maximize cash flows, the more you can maximize value. So that's what usually investors are looking for, both in the, maybe not the short term, but the middle term, or for the exit, is what are we investing in? How can we maximize cash flows? And that cash flow is what's going to equate to value over time. So certainly part of it is understanding, if you're doing an investment, you're doing a sale, who are the buyers of the company, who might bid for it. So if we talk about financial buyers, we talk about competitive or corporate buyers, and they have usually different objectives, and the benefits and the cash flows and the valuations may be very different. Financial buyers are buying for the investment, and usually what they want to do is they want to go in, help the company, hopefully maximize cash flows, and they want to sell. And we talk about a time horizon of 3 to 5 years, maybe 3 to 7 years, but really they're not there for the long haul, because they're investing in the company with the intent of turning or selling the company at a future level, and obviously, hopefully at a profit. The corporate people, on the other hand, are maybe buying this to consolidate a number of companies. You see it in roll-ups, as you want to get a company bigger. So they still might sell at a roll-up, but you're trying to get different elements. Or as I mentioned earlier, you may have one that's into company that's into distribution, another that's into cultivation. Well, maybe combining those two, you get some vertical integration, and you can maximize some profit that way. Usually, the corporate buyers usually pay a little more. They usually are not necessarily buying to sell, but they're buying to hold. And there are the synergies that everybody talks about that you can get. So if you have two companies that are doing different parts, or in different parts of the country, different parts of a state, you might be able to cut costs for duplicative functions. You might be able to get some buying power, so better pricing on certain things. And those are things that really come into play with the corporate buyers. But again, they usually tend to buy for the longer term, but that's not always the case. You go to the next slide, please. All right, so I think the last main slide here is really on the purchase price for sellers. So really understanding, how was their value established? So, a lot of advice we give was, okay, is $10 million a fair value? And I don't know the answer to that off the face. So say, okay, well, how was that 10 million determined? Is it a multiple? Is it based on cash flow? Is it based on market size or relative value of one company versus another company? And those are the things that you want to understand. And you want to understand the assumptions behind them. We talked about the discounted cash flow earlier. So if the $10 million hypothetical value is based on a 15% discount rate, what would it be on a 12% discount rate? Or if it assumes 5% growth in years 3 through 5, what would it look like with 10% growth? So understanding the underlying assumptions is key when establishing or evaluating offers over time. The other thing too is, does it take into consideration some of the things we talked about or the synergies? What will they do with it? Will they be able to cut out the duplicative finance and accounting team? Can they sell more product through the same sales channels or sales people? And if those are the case, again, you wouldn't get all of that value as a seller, but you might be able to get some of that value. Do you have permits that they don't have? Or do you have anything unique that they can't do to themselves that may or may not fully show up in the financials? And those are things you can do with it. And it's usually people that think that buying is quicker than making or developing themselves. And so there is a premium for that. And you just want to understand how the values were coming about. Are those premiums included? What are the key assumptions? What happens if you do some sensitivity on some of those key assumptions? For publicly traded companies, a little different in this industry, but one of the biggest things is earnings per share, because that's what they're announced on. A lot of companies are valued by it. And so to the extent that you have a negative impact to the EPS, that's going to impact value. But if you can bring a positive impact, so if a company is trading at 6 times EBITDA and they're going to buy you at 5 times EBITDA, well, what happens is now you're creating value as part of this acquisition for this company, and that will result in positive valuation for you, and you'll be in a good negotiating power with that company. So the important is knowing who is buying, what they're buying, why they're buying, and what are some of the key questions or assumptions that impact value. And finally, we see this a lot. Haven't seen it as much in the cannabis industry yet, but we will see it, I'm sure, over time. There's going to be disagreements about value. I like to joke that if I'm hired and there's 2 sides, a buyer and a seller, if I piss off both sides, it means I've come up with a pretty good value, because obviously the buyers want to buy low and the sellers want to sell high, and the value is probably somewhere in the middle. But having said that, there are times when the agreement on value can't be made. And so there'll be earnouts, whether it's based on revenue or earnings. What that is you come up with a base value, and usually there can be an increase in value if certain financial metrics are ultimately achieved. And that's what earnouts. And I think we'll see a lot of those over time here. All right, next slide, please. All right, so the next steps. Again, how should you prepare to get your company ready for selling? Is really understanding your financials. Because a lot of times, especially with private companies, financials are done for a variety of different reasons. So understanding what is in there, maybe what can be removed. Maybe you have some excess expenses, because many companies, especially when they're profitable, if they're expecting to hold them for a long time, aren't always looking to maximize profit as opposed to minimizing taxes. So that may be great from a tax strategy, especially initially. And I'm not suggesting anything illegal. I'm just saying that not all companies try to maximize profit initially, but if you're getting ready to sell, you want to start maximizing profit. You want to at least have what would pro forma financials be to show that I was trying to maximize profit. You know, add back any perks, maybe any family members that aren't actively involved but might be on the payroll, and just looking at things, or maybe investments that you're making today that you won't need in 2 or 3 years from now because you are making those investments today. So capital expenditures might be less, and maybe depreciation and amortization over time will be less. Or so those are things. Or even if you're making the investment today and you want to sell close now, but maybe some of those realizations of the earnings benefits won't be realized right away, do a pro forma saying, okay, based on this, we expect that EBITDA margin to be 10, 15%. And this is why, and try to show that. If you are patient and you know that your horizon is a little bit longer, but maybe you have to make some infrastructure or other investments, make them now so you'll see the benefit in a few years, assuming capital is available to you. And if you're able to do that, you very likely might be able to realize a higher price because you've made that investment, and then you'll be able to start showing that in your financial results. Can we go to the next slide, please? All right, so this will just some of the valuation capabilities of why we do valuations. Certainly people will do them for 409A purposes, which is value of stock options. So we're starting to see companies like in the cannabis industry, like in high tech, issue options to incentivize employees. Certainly to the extent there'll be consolidation in the industry, there will be acquisitions, and then you need the valuation of the intangible and tangible assets for your books. So we're starting to see some of the purchase price allocations. Haven't seen this so much yet in this industry, but as companies acquire and put assets on their books, put goodwill on their books as part of acquisitions, if we have times of declining stock prices as we're seeing today, and we're seeing this in other industries, you'll start having to do impairment testing or test for the value of those assets over time. And then other things we'll do is we'll do Monte Carlo simulations to maybe look for earnouts. It's a common way people will value earnouts, especially based on revenue and EBITDA or financial metrics. We can do fairness opinions, and if there are complex securities or multi-class capital structures, those are things that we value frequently. And again, we're seeing that more and more in valuations of cannabis type companies. All right, I think after that, we are opening it up for questions. Can you go to the next slide, please?
All right, thank you guys. If you have any questions, please feel free to put them into the question and answer box. We have a bunch to answer from William and a few from Kiev, as well as Jose. And to quickly answer Chaz, yes, we will be sending a recording after the meeting. Make sure that you all are on our CREC newsletter so that we are able to send that out to you. All right, we'll start with Jose's. In the DSC, what was the time value of money preference and risk premium, and how is it calculated for buyers and sellers? And also, Greg, are you able to see the question and answer?
I can see the open. Are you looking at the answered?
Yeah, there's both. So I'm starting with the one from Jose that we received first.
In the DSC, so are you talking about the discounted cash flow approach, I'm assuming? What is the time value of money preference and risk premium, and how is it calculated? So there are different ways of calculating the discount rate. As I mentioned earlier, it may be different for the same company in different scenarios. So the typical way people have started, start with valuing or discount rates or coming up with discount rates is using the CAPM or capital asset pricing model, looking at the cost of equity, cost of debt, and weighting the two. The range is really varied. I saw in a shareholder dispute, two different companies they had valuations by two different companies. One used a 30% discount rate. One used a 50% discount rate. So they really vary. I would say, the range is usually not too much lower than 20%. I know it's hard to say that because it's not a factor that we look at in isolation. As I mentioned earlier, it needs to be considered in reference to the overall financial projections and the riskiness of them, as well as, you know, what your assumption is in the terminal value and what method you're using to calculate your terminal value. So it's really calculated, I think, by looking at the capital asset model. We look at venture capital rates of returns. We add in company specific risks, which candidly is a appraiser's way of using their internal judgment based on experience. But I'd say the rates are, I know this isn't going to be a good answer, but it's between 20 and 50%, depending upon the specifics of the company and their financial projections.
Great. Yeah, and Greg, we have a lot of questions at this point. Thank you, everyone else. So let's try to be efficient when we can.
Okay.
So William is asking about 280E and gross profits, which is tax instead of net income.
Yeah.
And so why multiple revenues?
Revenue multiples are used primarily just for ease. And a lot of companies, if they don't have good earnings, you default to them. As I mentioned earlier, we try not to use revenue multiples, and we try to use the discounted cash flow approach if possible if you're not profitable, but sometimes we'll go that way just for ease and convenience.
Okay. Now, what are you doing if a cannabis company is going bankrupt? Does that affect the valuation if they can't file for bankruptcy protection?
Sure. So if a company is going bankrupt, that would be the situation where you might use the cost approach, because what you're assuming is you're liquidating the business. You might get some value for some intangible assets, but usually if they're going bankrupt, there's not a lot of value for those. So you'd probably look at more of a liquidation or an adjusted cost approach in that situation.
Okay. How would you provide valuation for startups in the industry? And I might even assume that everyone is a startup in some form.
Yeah. So, you know, startups they're fun to value, they're challenging, but when you've been doing it for a long time, you want to do something that's a little bit outside the norm. So that's usually when helping a company with a discounted cash flow approach is the best method to use, because what it does is allow you to kind of start with a blank slate, if you will. What are you planning to do? What are your growth rates? What is your investment? What are your future projections? And risk adjust those to the present value. And it goes back to an earlier question, that risk factor may be very, very high because it is a startup company with very limited history and or visibility even of what will be in the future. But I would say that the discounted cash flow approach and helping companies do that would be probably the best method for that situation.
Okay, can you touch upon comparables, since
Sure.
it's such a complicated part of the industry?
Yeah, and as I mentioned earlier, it is challenging, especially in the U.S. But you know, we subscribe to databases, and there's a couple standard ones. Capitals IQ is the one that we use, and they have domestic, international companies. So we're able to find some comparables in the international space, and that's what we tend to use in doing these valuations. If we indeed, again, use the market approach. The trend, as I mentioned earlier, is to use the DCF if possible, or a version of the income approach. But looking at comparable companies, searching by keywords, looking for companies with regulations. If we can't find enough good cannabis companies, would be another way to do it. But it tend to look more at the international space than we would at the domestic space. And you know, the information is good. It's not great, and also depends on how liquid the stock is, because some of these stocks trade well, some trade sparsely, they're very thinly traded, and that data becomes more challenging. So you really have to go through and ferret out that information analysis by analysis. So we do try to find companies in the space. We do try to go a lot in the international space, and if not, we'll try to find companies that maybe have similar or facing similar economics, regulations, et cetera.
Okay, and moving on. What time frame is typically used when you're using the income value approach?
Yeah. So if you read any book, it always talks about 5 years. But having said that, the time that you should be using for an income approach is until you get more to a stabilized level of growth and profitability. And that may be 5 years, it may be 4 years, it may be 10 years. And I know People tell me I can barely project out 2 years. I can't get out to 10 years. But so 5 years is the norm, just because that tends to be convention. It's supposed to get you through cycles, et cetera. But the way I think about it is, all right, where do you think you're going to get to? Is it going to be, again, an EBIT or an EBITDA margin of 10, 15%? All right, how long will it take you to get there? So that's kind of how I think about the length of the projections is, here's where I am today, here's where I want to get to, and how long will that take? Like I say, 5 years is the norm, but I would say 3 to 7 years or 3 to 10 years you'll see as well.
So I'm going to try and get through some quick ones. Can you confirm that if the discount rates vary from 20 to 50%, that the EBITDA multiples typically fall in the 2 to 5 times range?
I'm sorry, the what multiples fall in the 2 to 5?
If the discount rates vary from 20 to 50%, do the multiples also fall in the 2 to 5 times range?
No, it's not quite that way. It might. So what I think you're doing is you're converting a discount rate into a cap rate for like you do in real estate. It's a little bit different on business. So usually then, if you're using the very high discount rates and you want to convert that to a cap rate in valuation, you may not use that same discount rate as part of the cap rate. So you might use a lower discount rate to have a higher valuation or a cap rate at the end. I guess it's lower cap rate for real estate, but a higher multiple at the end. So you have a high value, but you're still discounting it at that high rate. The alternative is people will use multiples of EBITDA, and they might use 3 to 5 times. They might use 7 to 10 times. It just depends on the industry and what they're seeing at that time. Because as I mentioned earlier, the multiples are dynamic. So we just need to see what those multiples are over time. So it's usually, it can be related to the discount rate, but usually it's more when it's in that 15 to 20 or 25%. But when it gets up to 25 to 50%, you'll make some adjustment to the multiple or the terminal value at the end.
Okay, another quick one. Megan, yes, we will be sending out a copy of the slides. We'll be putting together a blog post recapping the video and send it out potentially next week, potentially right after this call. Greg, would you value a license only differently? Do you have an approach for that versus the real estate side? Yeah, so licenses, trade names, and things like that can be valued a couple of different ways, and it would be different. Usually, you might use a cost approach for that, because what would be the cost, opportunity cost to getting that license if you could get one by doing it yourself? So what you are doing is you're saving some time, you're saving some resources, so you can value it in that method. The other way people will look at it is, if I didn't have this license, but you have it, I could maybe license that from you, and maybe you pay a percentage of revenue or whatever the metric is and license it over that for some period of time. But usually those don't have the terminal value or the cap rate we were just talking about, and they may be valued over shorter, the projections may be longer, but the implication is its values over a shorter period of time by not having the terminal value. And does that change whether it's a pre-operation entity and local permissions, so a step earlier in the process? Yeah, so again, we talked about you could either do a cost approach or an income approach. If you're in the pre-revenue or operations, but you still need that license, you'd probably look at it as, okay, if there aren't market for those licenses, i.e. Where you can buy and sell them, you would look at what is the timing, what is the opportunity cost for me to license it versus build it out myself, and that's what I'd be willing to pay for it. And do you see any difference in working in the hemp industry versus cannabis, since there's a little more gray area? We do see a little bit more difference in the hemp industry. We've done a little bit in the hemp industry, but the regulations a little bit looser. So we see, depending on what we're valuing, we see values a little bit differently in that industry. So certainly the companies, like we did one where we valued the inventory of the hemp seeds. We looked at one where the banking was easier in the hemp industry, so it made some of the cash flows, I don't want to say easier to achieve, but maybe a little less risky, or the business operations overall a little risky. So we do see a little bit of difference in the hemp industry versus cannabis. Could you briefly state the URL or the name of the comparable source that you had mentioned earlier?
So it's not a URL, it's a subscription, and it's very expensive. We use capital, which is the word, and then IQ, as in, you know, intellectual, so CAPITALIQ.com. It's I think it's owned by Standard & Poor's. You know, that's where we do our searches for comparable company, get the historical companies. You can do a little bit in the Edgar or the Yahoo. You look for competitors in that, once you find a couple companies. So Capital IQ is the one we use, but it's subscription oriented. It's comprehensive but expensive.
And that's one of the tools that we've been working on within the CREC Portal as well, is to gather the comps for real estate and license sales. And as you can see, there's some expensive options out there, but that's one more piece that we're adding into the portal.
Great.
So a lot of people were referencing the 280E taxes. And did you want to read the very final question by Adam? A little longer. In open.
Give me a second here.
Since 280E taxes are a huge amount, do most of your engagements include a tax opinion analysis to determine whether the company paid the appropriate amount of taxes in the past? Since licenses are involved, I assume that most cannabis M&A transactions are done not on an asset purchase, but a stock purchase?
Yeah, that's a great question. And I don't know if I would say always, but I certainly say that that's one of the advantages of our firm, is we have people that do specialize in that, and we do our valuations. We usually do the proposals jointly with the tax team so that companies have that option to assess that. I don't say that everyone does it. I wish they all did. As we talked about earlier in kind of the unique issues, understanding and getting those tax issues addressed, if you will, has a positive impact on valuation, because it just removes an unknown. So I definitely would recommend it. We do recommend it to our clients. We do have, you know, the tax professionals that specialize in that area, but I wouldn't say that everyone does that.
So have you found that there's a large percentage of cannabis companies that have significant problems with their historical financials? And do you have any suggestions for companies that may be unclear of their financial?
Yeah, I would say that, because again, a lot of companies, especially earlier stage investing, they don't invest in having someone do their financials. They do it themselves. Often they're on QuickBooks or other, you know, type of platforms that are much earlier. I wouldn't say that you need to get audited financials. I mean, obviously we do that, but I wouldn't say that you need to do it at the earlier stage. But I do think you want a professional firm to go through the financials at the early stages, you know, identify the issues, just to make sure that they're, you know, I would call them gap oriented, not always 100% gap employment. I'm sure my audit guys will hate me for saying this, but certainly in the early stages, you want a strong understanding, and you can hire firms to do that, to put the financials so you've addressed them, and they're done in a way that they would be done for taxes, or maybe they would be done for audit purposes without getting that actual opinion. I think that's very helpful. It does cost some money, so there's always a time and place for it, but it will have a positive impact on, you know, how people look at the company and the investment you've made in the company, the understanding of the historical financials. Because if you can't understand them, or if they're done in ways that maybe are contrary to, you know, we'll call typical accounting rules, it makes it very hard for us to evaluate it. It makes it hard for investors to evaluate it as well.
Okay, quickly moving forward, have you ever worked with a Cannabis Lab Company that was for purchase or sale?
I haven't personally worked with a lab company. I don't know if anybody within the firm has, but certainly I haven't done an evaluation of a lab company. Certainly done, you know, cultivating and others, but I wouldn't call it really a lab company.
Okay, and circling back around to the licenses, do you think that the value would increase when there's an area where there's a limited supply of licenses? As an example, Oregon.
Absolutely, absolutely. To the extent that, if you will, the limited supply impacts competition or future competition, that's going to have a positive impact on value. And similarly, as I mentioned earlier, temporary versus permanent license. The permanent license is going to have a positive impact on value because not that the permanent can't be removed, but it just takes another risk out of the company. And that's really, valuation is measuring both financial and non-financial risk through the cash flows, or the riskiness of the cash flows. To the extent that you can mitigate any elements of that risk is going to have a positive impact on value.
Okay, only a few more. I assume that we have a 12 o'clock hard stop. If you are taking into consideration the intellectual properties, how much are you seeing this as a portion of the overall value?
Yeah, so again, if you're valuing a company, you end up valuing the intellectual property in its entirety as part of the valuation process. You don't do it explicitly, you do it implicitly. So for example, assuming all the assets and liabilities are on the books at their fair market values, if you valued a company at $10 million, but the book value was $5 million, you've inherently said that the intellectual property is worth $5 million, which is the difference between the fair market value of the equity and the book value. So we do that, obviously. People talk about that. Other than in an acquisition, or if you need to value a permit or something discretely, we don't usually see that 5 million segmented into what its components are. Is it goodwill? Is it the trade name? Is it the customers? Is there something unique in the process, that you do? It's all included in there. Is it the workforce? We don't usually see that split out unless we have to do it for a post-acquisition purchase price allocation.
Okay, final question, and you're all welcome to reach out again after and pick Greg's brain further and talk up to the professionals of Armanino. They are a large company that can do much more than just the topic of this conversation today. So how do you value when income taxes are based on GPM versus the net income? So GPM, I'm not aware of that acronym.
Gross profit margin, I'm assuming. Could you repeat the question, please?
How does it affect your valuation when income taxes are based on the GPM versus their net income? And I think that's referring back to 280E again.
Right, right. When doing valuations, so you would take the gross profit margin and you would try to get to actually cash flow as opposed to net income, unless you're doing an EBITDA type multiple. So it doesn't really, from a valuation standpoint, I'm not talking about 280 perspective, it doesn't really matter what metric you're using. So, I've even seen people do, discounted cash flows, not in this industry, on gross margin versus cash flow. And you would adjust either the multiple, you adjust the metric, the discount rate, et cetera, to reflect what it is, what metric you're using for the valuation. So from a valuation perspective, you'd make whatever necessary adjustment based on the financial metric that you're using. If we were doing a cash flow analysis, we wouldn't do it on gross profit margin. If we're doing a multiple, you could do a multiple of gross profit margin, but the multiple would be reflective of what you would see in the industry of other companies being valued using that same metric.
All right. Thank you, everyone, for your great questions. Greg, if you can send us off with one more thought about what's the best thing that people can be doing over the course of their business to prepare for a future valuation.
I would say, and that's a great question, I would say, again, understanding your financials. And if your financials are not representative of what you think the potential of the business is, find ways to demonstrate what the potential is and create these pro formas to show this is what our business's real true operations are, because that's how you're going to be valued. So if you understand your financials, you understand maybe adjustments that need to be made, having pro formas over that to reflect those changes is the best thing you can do, because we find that the better you know your company, the better you know the financials, the easier you can answer these questions. It will be very positive for you in the future.
Great, thank you. And if you have any questions, you can reach out to the experts at Armanino LLP. I'll put the email address up one more time. You're also welcome to reach out to CREC. We have a growing network of partners. If you're interested in also giving a presentation to our network, please reach out. Thank you so much for joining us. Everyone stay safe, stay sane, and we'll see you on the next one.
Thank you, everybody.